What is liquidity risk? How can a profitable company suddenly collapse? How can a bank that looks strong on paper struggle to survive? How can a business showing growth fail to pay salaries? The answer is liquidity risk. Many people confuse profit with cash. But profit is accounting. Cash is survival. A company may report strong revenue, but if it does not have enough cash at the right time, it can face serious trouble. Liquidity risk is not about loss of business. It is about timing of cash. And in finance, timing is everything. Let us understand liquidity risk in simple terms. Liquidity risk arises when an organization cannot meet its short-term financial obligations when they become due. It does not necessarily mean the company is insolvent. It means it does not have enough liquid funds available at that moment. There are two main types. First, funding liquidity risk, when an institution cannot obtain funds to meet obligations. Second, market liquidity risk, when assets cannot be sold quickly without major loss in value. Imagine a company that has assets worth crores, but cannot convert them into cash immediately. That delay creates stress. Liquidity risk is about cash flow mismatch, when money going out exceeds money coming in at a critical time. Let us simplify this further. Suppose a person earns a good salary, but salary credit is delayed by 2 weeks. Meanwhile, rent, school fees, and loan installments are due. Even though income exists, temporary cash shortage creates pressure. That is liquidity risk at an individual level. Now imagine this situation at a corporate or banking level. Banks borrow short-term and lend long-term. Companies invest in long-term projects but rely on short-term funding. If funding sources suddenly dry up, pressure builds quickly. Liquidity risk spreads fast because it is linked to confidence. Once lenders lose confidence, refinancing becomes difficult, and that is when stress turns into crisis. In banking, liquidity risk is extremely critical. Banks accept deposits that can be withdrawn on demand, but they lend money for longer durations. This creates maturity mismatch. If a large number of depositors withdraw funds at the same time, the bank must arrange cash immediately. Even if the bank's loans are good and profitable, it may struggle to generate cash instantly. This is why banks maintain liquidity reserves. They hold high-quality liquid assets that can be sold quickly. They also maintain access to emergency funding sources. Liquidity management is about preparedness. Because once panic begins, it spreads rapidly. And liquidity crisis can destabilize even otherwise sound institutions. Liquidity risk is dangerous for 3 reasons. First, it escalates quickly. Unlike slow operational issues, liquidity stress can develop within days. Second, it damages confidence. Investors and lenders react immediately to liquidity concerns. Third, it creates contagion. If one institution faces liquidity stress, counterparties may withdraw exposure. This creates a chain reaction. Many financial disruptions have involved liquidity pressures, where institutions had assets, but not enough immediate cash. This is why asset-liability matching, cash flow forecasting, and diversified funding sources are critical. Liquidity discipline protects stability. Without it, even profitable institutions can become vulnerable. Here is the most important lesson. Profit does not guarantee survival. Cash flow does. Liquidity risk management ensures that obligations are met on time, regardless of market stress. It requires planning, forecasting, and maintaining buffers. Strong organizations do not wait for crisis. They prepare for funding stress in advance. They diversify borrowing sources. They maintain liquid reserves. They monitor cash flow continuously. Liquidity risk reminds us that financial strength is not only about income. It is about timing and resilience. In business and finance, survival depends on the ability to meet commitments when they fall due. And that is why liquidity management is not optional. It is essential.